If you've ever sold a covered call before and watched the stock explode higher after and thought, I messed up, this video is gonna completely change the way you look at trading. This is a must watch. Because what if I told you this? The trade worked exactly as it was designed to work. And the thing that most people do next is the absolute worst possible move they could do. And stay until the end because I'm going to show you one thing that almost no retail traders check. Something buried in SEC filings that are completely public to you if you know where to look. And it will completely change and improve the way you trade stocks like this. I'm gonna walk through all of this content using my screen, click by click, and show you exactly where to look and how to interpret the data. Now, you don't have to be some math guru or MIT graduate. I'm gonna show you in easy terminology and super easy steps. You have to watch this video. This is one of the best videos I think I've made. Now, before we jump right in, I wanna say thank you. The channel recently surpassed 5,000 subscribers. Now let's make it to 10,000 next. If you're not subscribed already, hit the subscribe button. It helps other people just like you find amazing content just like this. I'm literally putting up a video every day to help you create income for yourself and not lose your money. So let's jump right in. Okay, so first we're going to take a look and see this viewer comment. Hi, Michelle. I worked the wheel strategy on IREN recently. I bought the stock at $38.12 and I immediately purchased a covered call at 41 with an expiration date of February 20th. I received 5.35 of premium. The stock has blown past my strike and today is trading at 45.68. When this happens, I usually think about buying to close and rolling it, but it costs a fortune to do this and I feel like I'm going backwards at times. I'm curious what you do and if you might have a video on this subject. That is a great suggestion, Dan, and this video goes out to you. First, let's take a look at IREN. Here is a 1-year chart, and we can see visually that the stock was very low and kind of sideways for an extended period of time, from around January this year, and then started its uptrend around June. And you'll see it went from like $10 per share to a high of $76 per share back in November. It subsequently dropped to about $33, and now it's up to $48. Let's break this down step by step. And if you're trading options, this is probably one of the most important videos you'll want to view to learn. Now, before we jump right in, let's just take a moment and talk about terminology briefly. The viewer posted that he bought a covered call. Now, I'm assuming that he meant he sold a covered call and just wrote bought accidentally. But you want to make sure that you're using the correct terminology as you trade. This isn't a scolding at all. It's just a helpful correction because the more often you use the correct terminology, the less you'll tend to be confused. So let's get back to it. So let's recap what the viewer did. He bought IREN stock at $38.12. Then he sold the $41 covered call with an expiration date of February 20th and collected 5.35 in premium. That equated to $535 being dropped in his account right when he made the trade. Now, the stock is trading at $45.68. Actually, as I'm recording this video, the stock is actually trading at $48.51. Now, that is not a mistake. This is literally the textbook definition of a successful covered call. Let's walk through it together. Okay, you sold a covered call for 5.35. That equals $535 that got dropped into your account right when you made the trade because each contract represents 100 shares. Now, if the stock were to get assigned and you sell your shares at the strike price of $41, let's walk through how much money you'll make. $41 minus $38.12 that you paid for the stock. That means you'll make $2.88 per share times 100 shares equals an additional $288 on the stock gain. Are you with me so far? So if we make $535 for selling the call, and we make another $288 if the stock closes above the strike price at expiration, our viewer is making $823 on the trade. If he's making $823 and he's putting up $3,812 in capital to make the trade because he bought 100 shares at $38.12, to get your rate of return, you're going to divide the premium into the capital. So you're going to divide $823 into $3,812. This viewer just made 21.58%. So let's just stop right here for a moment. The viewer made 21.58% return, or will make that if he holds the trade until expiration, but he's considering rolling the trade. Why would you do that? You are making money. You don't want to turn a winning trade into a losing trade, and rolling your contracts is the easiest way to do that. He feels bad because he sold a $41 call and now the stock is at $48 and change and rising. You don't want to feel bad about that. This is one of the biggest mistakes options traders, particularly options sellers like we are, can make. The whole purpose of selling a covered call is for you to make guaranteed income. He already made guaranteed income in the amount of $535 by selling the call. He keeps that no matter what happens. When you sell a covered call, you're giving up upside potential for guaranteed income. That's the whole purpose of a covered call. This trade did exactly what it was supposed to do, and it's actually the best result possible. Now, I want to walk through one other thing, because it might be very advantageous for the viewer to actually liquidate the entire position right now. Let's go through that together. This is literally one of the things that 99% of traders don't ever look at. And this is what separates a profitable trader from an unprofitable one. I created this handy spreadsheet to show you mathematically. Now let's plug the numbers in together. Right now the stock is trading at $48.91. He paid $38.12. He sold the February 20th $41 call. It last traded at $11.51. We're going to use that number for now. We're going to use this spreadsheet that I created to see if it makes sense for him to liquidate his position now, not rolling the contract, but buying back his short call and then selling his shares versus waiting until expiration. Now, you'll notice here's our $823 if he waits until the contract expires on February 20th. If he were to liquidate his position now, by buying back his call that he sold for $11.51, he would lose $616 on that trade. However, he could at the same time sell his shares and make $1,079 because it's currently trading at $48.91 and he purchased the shares for $38.12. That would give him a net profit of $463. So let me recap this for you guys. Rolling is not smart, because he's already making money. And rolling gives you the opportunity to turn a winning trade into a losing one. And that's the worst decision any trader can ever make, bar none. So he has two choices. He can wait until expiration, and the least amount he can make is $535 because that's the premium that he sold the call for. And if the stock price stays above $41, he'll end up getting assigned on his shares and he'll make the whole amount of $823. But he would have to wait until February 20th to do that. If he liquidates his trade now, he can do so at a $463 profit today. Now here's the rest of the magic, guys, and here's the thing that most traders never even look at. Why is it that IREN is pretty flat, goes up pretty slowly, comes down, and then starts to explode? If you're trading a stock and you're not looking at the SEC filings, you're doing yourself a disservice. The SEC site is a free site that all public traders can access, and it shows all the filings for the companies. Now, it can be very confusing because these are probably terms that you're not familiar with. 8K, 424B, ownership disclosures. It's like another language. So I'm not going to spend time in this video and show you exactly what to look at, but I'm going to show you the content that explains IREN's behavior. When I look at IREN's filings, two dates really stand out. On October 7th, the company disclosed that it had already issued tens of millions of new shares through an at-the-market program, meaning new shares were already being sold into the market. They also announced a convertible notes offering, which is debt that can turn into shares later. Then, on December 8th, they doubled down. They issued a large block of new shares and completed a multi-billion-dollar convertible note deal. That's both immediate dilution from new shares and potential future dilution from convertibles. Now, none of this means that the stock is going to crash, but it does mean that there's more share supply and more dilution risk, which can act like a lid on the stock. So I'm not giving recommendations, but this looks a lot to me like what happened with MicroStrategy earlier. And if I were this viewer and I already had a nice profit, I would seriously think about taking the win and redeploying that capital into a different ticker instead of waiting and possibly having my win turn into a loss. All right, guys. So what'd you guys think of that content? So thanks for watching. Thanks for subscribing. And thanks for being here. Happy trading.